Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Very nice. This is what a lecture theatre is supposed to look like. Everything nice and new. Okay. Okay. I haven't even started yet. Already yawning. Curtains, open or close. Wow, the luxury. It's amazing. How does this work? Ooh. Okay. On. Oh, maybe that. It's like Jaws, the shark is coming. Okay, so that's no good. How do I do that? So is this on? On, off, off. So this is wireless, what, 4? Okay, so let's do it this way. Mute, 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 mute. Oh, look at that technology. Excellent. Woohoo! That's why I have a PhD. Yes. Okay. So let's check the recording first of all. The computers are slow here as well. Can change the menu. I don't know why they put optiplexes. as a lecturing computer. I don't understand. Okay, launch. And that's us. Look at that, working for once. Okay, so we can close that. Let's talk about this lecture. So it should be a short lecture for once. The lectures will get a little short now that I've talked about all the stuff you need for assignment number 1 and 2. So the lecture should get shorter. I think it's like 13 slides today or something like that, which is quite nice. And so there'll be time afterwards to ask questions about the second assignment. If you, no, sorry, that's last week. How do I go back? To ask questions about the second assignment that hopefully you should be working on. So let's start. Okay. And we need this, and this is from last week, but we need that too. Okay. Oh, this is nice. Look at this. You can have a seat, like a lecture like this, right? I like this. This is good. It's a shame. Okay. So today shouldn't be too bad. Let's get started. So today, sensitivity and scenario is the object here. Sensitivity and scenario is something that you see as an sort of additional analysis to discounted cash flow. There's no such thing as scenario or sensitivity for multiples. The only sensitivity or scenario, if you like, is doing a range, a high-low range using for your ratios. So not just using the current PE ratio, the current EVL, also using a high-low range, maybe based on one standard deviation of the last 5 years or something like that. What I showed you in the workshop last week, no workshop this week. Sensitivity and scenario is only for discounted cash flow. So, and it is used not as common as it once was, maybe because people just become so time poor that sensitivity and scenario aren't used as much. In Credit Suisse, I didn't see much of sensitivity and scenario. I did it, one other person did it in my team, and that's it. So it was 2 of us who actually looked at this stuff. But it can be important for a number of reasons. So, well, let me talk about the main purposes of sensitivity and scenario. It's to really answer the question, what if? That's what the main purpose of the analysis is. It's to ask, what if my growth forecast is not for JB Hi-Fi, not 4% over the next 5 years like I predicted? What if it's 0? What if it's 1%? What if it's something less or something more? Yeah. So that what if actually an important question, because you can think of your forecast, like it says there, as your best guess of what the company is going to do in terms of opening the number of stores, in terms of its growth, capex, WACC, that sort of stuff. But what if interest rates go up? Right? Currently, they're very low. Interest rates are tiny, 1.5%. The company could borrow at 3%. It's ridiculous. That's very, very, very low. Realistically low, right? What if the interest rate was 5%, which is something more realistic? What if the company had to pay 5% on its debt? The WACC would go up, valuation would go down, of course, but by how much? How would that affect the stock price? How would it affect the ROIC, right? These are important questions. So your valuation that you did for assignment number 1 is the most likely outcome with respect to your best guess predictions for the number of stores, how much growth, how much WACC, how much dividend, all those sort of assumptions that you made in your forecast drivers tab. But life is not like that. It's a best guess. It's going to be wrong. And sensitivity and scenario really allows you to answer the question, if I got it wrong, what's the impact, right? How wrong can I be before my recommendation, before my stock price per share prediction is below the current share price, right? The idea behind valuation, both ratio and DCF, of course, is to value your company, whatever you're valuing, JB Hi-Fi, Fortescue Metals, BHP Billiton, Rio Tinto, Telstra, whatever it is. So this semester we're doing JB Hi-Fi. And the whole idea is for you to value the company, get a valuation per share using DCF and ratios, and compare it to the current share price. And of course, if your valuation is higher than the current share price, you have a buy recommendation on the stock. You should, at least. And if it's substantially high, in practice, analysts, when they get a valuation, let's say $25, and they see a stock price of 24, that's probably a hold, it's not a buy. You want at least some kind of a buffer, at least 10%, before you turn your recommendation into a buy recommendation. And one reason is because you know that your valuation per share that you got is, again, a best guess. That's all it is. It's a prediction that's going to be wrong. And if you're wrong by 10% and you predicted a buy, you can still not lose any money. Your clients care about not losing money. Of course, everybody does that. So if you recommend to buy a stock and they buy it, they follow your recommendation, and they lose a bunch of money, guess what? They're not going to come back to you and pay you a fee or your bank a fee for your advice. They're going to go somewhere else. So sensitivity and scenario helps in this situation because it really answers the question, well, given that we're going to be wrong, how wrong can we be before our recommendation starts losing money, right? So if we're wrong, if let's say our growth forecast was 4% for the next 5 years, what if it's 3? If it's 3, then the stock price is probably going to go down, my calculation in my KGW model. How much? How far down is it going to go before it goes below the current share price? That's a very important question. And it just goes back to this idea that my valuation is just the most likely outcome that I think is reasonable, but it's going to be wrong because it's a prediction of the future. Nobody has a crystal ball. Nobody can see the future. It's just best guess. And sensitivity and scenario tell us, okay, how wrong can I be before my recommendation starts losing my client's money and they fire me, right? So that's its role. That's its actual purpose. So think of your forecast that you made for assignment number 1 as your best single guess of an uncertain financial performance of JB Hi-Fi or whatever company you're valuing. It will be wrong. And sensitivity and scenario analysis attempts to estimate how wrong and what are the consequences of your valuation outcome when you start playing around with your key assumptions about growth, about WACC, about CapEx, about cost of goods sold, something like that. How wrong can your predictions be before your value per share drops below the current share price? It's an important question. So, and if you start asking these questions using sensitivity and scenario, essentially what you're doing is, what is the upside or the downside of my single set of expectations that you came up with in assignment number 1? Right? Because it's not just to the downside, it can be to the upside as well. You might be, I was a conservative analyst, and I just did the most conservative things that I thought were realistic. And so in my recommendation, there was also movement on the upside, right? Because for me, and I expressed this in workshops and lectures as well, to me, JB Hi-Fi is a mature company. The single digits, basically at population growth, is what I would expect from that company. Are the products nice? Yeah, sure. I like TVs, I like phones, I like washing machines. It's nice stuff they sell, but this is not about what they sell. This is about growth potential. And the growth for a mature company in a country with only 25 million people, which has which doesn't have a lot of household growth. We have the projections from the ABS. It's only 1.64%. I would expect for a company like JB Hi-Fi to have very low growth, right? 2%, maybe 3%, 4% maximum, right? So something like a upside, if I was an analyst, I would be very conservative. So for me, sensitivity and scenario would also serve to see what sort of upside potential. If I'm wrong, if I'm too conservative, if JB Hi-Fi can grow at 6%, 7%, which I think is unrealistic, but anything's possible, how would that valuation per share in KGW? Yeah? So all these questions come down to, what is my margin for error, right? There's going to be an error in my predictions. I'm predicting the future. I'm going to be wrong. what is the margin for error, right? Sensitivity and scenario both help gauge this distribution of share prices, right? In KGW, come up with one share price, right? KGW, this is just, I deleted everything, right? So KGW comes up with one share price, right? Whatever company I'm valuing. Right? But the future doesn't work like that. It's a point for, this is what this is what analysts refer to as a point forecast. I want you for your ratio is you want a range of distribution. I'm not talking about confidence intervals. You can think of them as confidence intervals if you like, but some kind of a range, because you know that a point forecast is going to be incorrect. It's just best guess. You want to see a range as well. And if the range is thinner, if it's shorter, then you have more confidence in your point forecast. If you have a wide distribution, just like in statistics, if you have a fat tail distribution that is very, very, the 67% confidence interval is very wide, then this point forecast is very uncertain. So it's not enough, in my opinion, as an analyst to just focus on one number. You want the range as well. And sensitivity and scenario help you with assignment number one, with a discounted cash flow valuation to give you a range. So that's quite useful, in my opinion. So let's take a look here. What else do I have for you? So sensitivity and scenario analysis both help gauge the distribution of the share price, not just that single number. We know that share price is driven by changes in expectations. So we can use our discounted cash flow model to not only identify important potential inputs of change, we can sort of guess those even without looking at the numbers. What's going to be important for a value per share? The growth, the WACC, the CapEx, right? The working capital items, depreciation, right? All those things are going to be important, but sensitivity shows us how important, which is quite nice. So in other words, magnitude of impact on the value per share by changing one thing, one key input, or changing multiple key inputs. In the whole idea of coming up with the skew, I have one value for the share price of JB Hi-Fi, for example. What is there potential for any upside or downside given this range of different values that growth can be, right? Growth, maybe I forecast growth for JB Hi-Fi to be 4%. Well, if I change that to 3% or I change it to 5%, how does that change the value per share? Right? That's a sensitivity question, sensitivity analysis question. So those questions are important, right, in my perspective. So let's start with the easier one, sensitivity. Sensitivity is an easier one to do. The difference between sensitivity and scenario is sensitivity, you change one input. That's it. Growth, or revenue growth, and see what happens to the value per share. Or change CapEx, and what happens to the value share. Change WACC, change beta, for example. What happens to the value share? Increase the risk-free rate in your CAPM estimation. What happens to the value per share? So you change one input and see, it doesn't have to be only value per share. Value per share is the key one. You also, maybe the ROIC as well could be an interesting one. Not only what happens to the value per share, but also what happens to the ROIC to answer that question. So in sensitivity, you only change one input. Scenario, you change multiple inputs at once. Right? So let's start with the easy one, with sensitivity. So it has two purposes. First purpose is, does your model work? Is your model consistent? And by that I mean, well, what should happen to your value and your ROIC per share if growth goes up? Value per share should go up, ROIC should go up, right? What happens when your WACC increases, your weighted average cost of capital? Well, your value per share should go down, right? Your ROIC shouldn't change, right? What happens when you change, let's say, the EBITDA margin in your model? What happens to what if it goes up? Well, what should happen? Your value per share should go up, and your ROIC should go up as well, right? So when you start playing with these key inputs, they also allow you to check the consistency to make sure your model is working properly. Because if you have a scenario where you increase the growth and your value per share goes down, there's something wrong. in your model, and you need to check it. You need to trace it. What's happening? Okay, revenue is going up. What happens? Did I link something to revenue and the cost is going up too much? What's the problem? Right? Because when you just increase, let's say, revenue growth, and you look at what happens to the ROIC and the value per share, and they don't go up, something must be wrong. There must be a mistake in the model with a formula or something like that. Okay? So, good idea for sensitivity. Also, not just see how sensitive your model is to changing key inputs, also to check if it works properly. Right? Examine diagnostics like ROIC, not just the value per share. And does the model work as expected? Does changing the model inputs lead to sensible or realistic changes to evaluation? So that's sort of like a check, if you like. It's not sensitivity, it's just a check to make sure your model's working properly. And the second, and this is where it gets its name from, the second purpose of a sensitivity is to check how sensitive your value or ROIC, value per share or your ROIC is to changing one input. Right? And the one question that is important here is if you have a number that you identify that is very, very sensitive by changing maybe even by 0.5%, it results in a big change in your value per share, you need to spend more time forecasting that number, right? So revenue growth is going to be important, and that's why we spend so much. Notice how we didn't spend much time, and I didn't care if you didn't spend much time on COGS, right, or working capital. First of all, for two reasons. First of all, it's stable because JB Hi-Fi is a retailer and they operate on a margin. And second of all, everything's linked to revenue, right? Because when JB Hi-Fi wants to sell more televisions, they have to buy more televisions from the supplier. So everything's sort of linked to revenue. So what did we focus on in assignment number 1? Revenue, right? That's the key input for any retailer, revenue growth, and how, in JB Hi-Fi's case, how many stores they open and what type of stores they are. That was the key variable. So in my sensitivity analysis, if I was to change revenue growth, something tells me your value per share would change quite a bit, both in phase 1 and phase 2 in KGW. If you start playing around with growth, your value per share will change quite a lot. If you start playing around with currency for JB Hi-Fi, nothing will happen. First of all, I was happy for you to ignore currency effects because they only have a little bit of revenue coming from New Zealand. And New Zealand currency is sort of linked very closely. It's highly correlated with the Australian currency, so it doesn't really matter. But if there was a company that you're valuing that does a lot of overseas business, does a lot of business in China, does a lot of business in Japan, does a lot of business in Korea, well, the Australian Korean won, or the yen and the Australian dollar, or the renminbi and the Australian dollar, that exchange rate would be very, very, very critical for us to predict. And it would be, and the more revenue I get from overseas, the more sensitive my value per share will be to changes in currency. Currency per share is hard to forecast, very hard to forecast. I think I have a lecture on it next week or the week after. It is extremely difficult, and it's extremely uncertain. So as a sensitivity, that's a pretty good example of what you should focus on, because you want to be able to say to your clients and in your report when you're writing a report about whatever company you're valuing, how sensitive your valuation is to assumptions about currency. You have to tell your investors that what happens if my currency goes from 80 cents to 60 cents for US, right? For Australian dollar goes from 80 cents to 60 cents. You have to be able to tell your clients, the people reading your report and looking at your valuation, how your valuation changes if that happens. Currency fluctuates a lot. So if it is a key assumption, you cannot just take the current exchange rate and assume it goes on forever. That's easy. Anybody can do that. That's lazy forecasting. Right? You have to be more sophisticated than that. Right? So what sort of inputs do I include in my sensitivity analysis? It's what you would expect. Right? Revenue growth, obviously, especially for JB Hi-Fi, very important. The other one, very important, is operating margin, EBITDA or EBIT or NOPLAT, whatever model you have. In KGW, it's EBITDA is what the model focuses on. Next, CapEx, very important, your prediction of CapEx. Currency, if the company does a lot of overseas business, this is a very important one. Very important. Currency is not something the company can impact, and that's very risky, right? It's outside the company's control. Even if they hedge, hedging is maximum for 18 months. Your model is 15 years, right? So even with futures, forwards, and options, companies do hedge quite a bit, yeah? Especially companies that do a lot of business overseas. That's a lot of risk, but the maximum they can sort of hedge is 18 months. There's no bank or insurance company that will sell them a future forward or an option contract for 5 years or something like that. These derivative contracts that you've heard about in other courses, they are not long-term. They are medium-term at best. They're sort of 18 months is the standard, the longest expiry that I've seen for these hedging derivative contracts. So hedging will not solve the problem, yeah, for a 15-year model. Continuing value, very important, of course. Even though it's in year 15 for KGW, it is a very large number, right, in your forecasts. So if you go to your model, for JB Hi-Fi, or if you go to any model, usually continuing value is huge. Yeah, big number. So if you go to my example from whatever week 3, and you go to valuation summary, here it's a relatively small number, but as you can see, order of magnitude bigger. When discounted, it's more reasonable, but still 10 times larger than the last cash flow. It's not a small number. It's a quarter of the value, right? So if the total value for the company is, it's 10% of the value here. That's a lot, right? So that also is and that's small. I've seen it 40%, right, of the overall value. So it can be a very large number. So that is also quite a common input, assumptions about your continuing value calculation. Maybe go to the forecast drivers if you're using KGW and have an assumption about long-term growth and see what happens to the value per share when you start playing games with long-term growth or the last ROIC that you input. We use option 3 in the course, but you don't have to. It's not a requirement. You can use option 1 and then see how sensitive your value and value per share is to changing these inputs here. Yeah. Cost of capital, WACC, of course. WACC, every single cash flow in a discounted cash flow setup is discounted at WACC, so you need to play games. You need to see how sensitive your valuation is to beta, right? Instead of just using whatever beta used in assignment number 1, 0.9, whatever it is, what if it was lower? What if it was higher? What would happen to the WACC? What would happen to the value per share? Equity risk premium, we use 6% or 5%. Historically, it sort of hovers between 5 and 7. What if we use 5? What if we use 7? Right? Cost of debt, big one. Yeah, in JB Hi-Fi and in any valuation that you do currently as an analyst, cost of debt is a massive sensitivity input that needs to be increased, in my opinion, because 3%, and a lot of companies are currently paying around that 3% for their debt, is unrealistic. Unrealistic. Unbelievable, right? That is going to go up. That is going to go up very quickly, right? So there's no way the cost of debt will stay at 3%. No way, right? And capital structure, we just use the current capital structure for JB Hi-Fi, but what if we use something like 50-50, 50% debt, 50% equity? Also a common sensitivity area that gets changed to see what the impact is on your valuation. So let's have a look at it. Sensitivity. This is sort of what analysts do, and this is from a past assignment that a student team did for using KGW. So this is what they did. It was an optional extra for one or two additional marks in the first assignment. I didn't expect you to do scenario. That's too complicated. But sensitivity was an additional, additional analysis that a couple of teams did. And all you had to do is take a key input, like let's say growth in revenue in phase 1, so from 2019 to 2023, and increase it by like there, up and down 1%, right? So this is sort of how it works. So we start with, I think it says here, the values for ROIC, EBITDA, NOPLAT, free cash flows are averages for 10 years, but you can do just phase 1, 5 years. It's up to you, whichever way you set it up as an analyst. First, you have your key assumption. Right? This is your assignment number 1 assumption for growth over the next 5 years. You increase that by 1%, or you decrease that by 1%. So each value here in your KGW model, in the forecast drivers up here, for the 5 years, you would increase each one of these 5 by 1%, right? And you would decrease each one by 1%, right? See what you get and see what the impact is. Only change that one number. Only change revenue growth for these 5 years. That's it. And see what happens to the value per share. See what happens to the ROIC down here. Right. So that's what I was looking for. That's all sensitivity analysis is. It's not very complicated. So revenue growth, this is my average assumption. I increase each one of those 5 inputs up or down 1%, and I say, what happens to my ROIC? Well, my revenue goes down by 1% for those 5 years. My ROIC goes from an average ROIC of 12.79 to 12.28. So the model's working correctly. ROIC has decreased because NOPLAT has gone up, gone down. The numerator has gone down. The change is about 4%. What happens to the EBITDA or EBIT margin? Well, it goes from 16.33 for the 5 years to something less. Again, makes sense. Revenue growths go down, your EBITDA margin goes down. NOPLAT margin goes from 11.22 to 11.17. Again, makes sense. Your free cash flow average for the 5 years goes from that to that. Again, makes sense. And finally, the important one, the most important one, your value per share goes from 3.44 for this company to 3.2, right? By just changing those 5 by 1 percentage point. Yeah. So as you can see, revenue is quite sensitive because I only made a very small change to revenue growth, and it made quite a substantial difference. A 7-point decrease or increase is not small. It's not small. So as you would expect in most models, revenue is very, very, very sensitive. Your value per share is very sensitive to changing the revenue growth. That's expected. It's not revolutionary. Of course, it's very sensitive. But this actually tells you how much. It actually gives you a specific number. Yeah, question? Yeah, it's a very good question. So for those listening, question from the audience, how do you choose this percentage, plus or minus 1%, right? So there's 2 ways that analysts deal with this issue. One is, what they do is you can have sort of 2 choices. This plus or minus 1%, it's arbitrary, right? You just come up with something, you could be plus or minus 2%, and then your question is, why is it plus or minus 2%, not 1%, right? So yeah, that's arbitrary. It's an arbitrary selection. One way that I did is, what I did was I went back, depending on which company, but I went back in time and I looked at the lowest growth the company that I was valuing had over the last, depends on the company, but over the last sort of 3 or 4 years. And I chose that as my minus. So I took, let's say, a company I was valuing had the lowest growth of, let's say, 1%, and I was predicting 4.83. So I would actually minus, not 1%, but minus 3%. So the lowest growth of the last 3 years for that company, assuming the company didn't have some radical change with an M&A or something like that. And if they did have some radical change, you probably ignore that number because it artificially changes your historical revenue growth. And then take the maximum value. Look at the growth over the last 3 or 4 years, the same period, and find the year that they had the highest growth without any M&A or any sort of artificial growth, and use that number. So if, let's say, the highest growth was 6%, my number would be, and I assume 4.83 like there, my plus would be 1.2, basically, to get it up to that 6%. So I would have a high-low range based on the historical growth of just the revenue over the last 3 years or 4 years or something like that. Don't go, as an analyst, don't go back too far because you'll start getting crazy numbers. You'll start You can only sort of, because companies change more and more often these days, you can only sort of, you shouldn't go back 20 years. You should go back maybe 4 maximum, maybe 3-4 years to come up with these numbers that are more sophisticated. So that makes more sense than just choosing up or minus 1%, plus or minus 1%. The other option that I've seen done is use one standard deviation. The problem with that is that when you use plus or minus one standard deviation, it's not a normal distribution. That's just a relic. Using plus or minus one standard deviation is just a relic from a normal distribution. And of course, no normal distributions here, especially when you have 5 observations. The only problem I have when you use plus or minus one standard deviation is you need, in order to make the standard deviation reliable, you need data. And if you're just using 5 observations to calculate standard deviation, that's not good. So in that case, if you have data for 20, 30 years, or maybe use data not on an annual basis, but on a semi-annual basis, because you have semi-annual data in Australia. In US, you have quarterly data because companies have to report their performance quarterly. In Australia, every 6 months, semi-annually. Maybe use semi-annual frequency for an Australian company to come up with a standard deviation. And in the US, use quarterly frequency to come up with a more reliable standard deviation number, and then do plus or minus one standard deviation. So all those approaches, I like both the standard deviation, plus or minus one standard deviation if you have enough data, or using the min-max for, let's say, revenue growth or COGS as a percentage of revenue over the last 3 or 4 years. That makes sense. The plus or minus one, that's just an arbitrary number. So if you don't agree with that, that's fine. That makes sense to me. It's arbitrary. So, but if you as a student team did that, it didn't bother me. But in practice, analysts do make it a little bit more sophisticated than just some arbitrary number. Yeah, it's a good question. Yeah, and you can't go too crazy, right? Because if you get a range, if you go too crazy, let's say plus or minus 10% or something like that, you'll get a very wide range, and then it's meaningless. Your sensitivity, you'll get a share price swing of from 3.44, you'll get a range, min range of 1.2 and a max range of $5 per share. That is so wide, it's meaningless. It's just way too wide. So it doesn't help come up with a sensitivity gauge in the analysis. So that to me makes no sense. So you cannot go too crazy with the plus or minus. But if the company did achieve that growth without any M&A, historically, that makes sense. And the plus or minus standard deviation also makes sense, conditional on enough observations. So if you start going crazy with these numbers, if they're too wide, it's just not useful. Yeah. So growth, as you would expect, big impact. Yeah, that's only 1% change for those 5 years results in a massive swing. Cost of goods sold, very similar to JB Hi-Fi looks like, this company. Again, plus or minus 1%, you would say, oh, that's a big number. Like if you do plus or minus to a small number like 5%, that sort of makes sense. Plus or minus 1% to a large number like this, sort of doesn't make much sense. So I would, as an analyst, I would probably expect something wider than plus or minus 1%. But as you can see, the student team here just did plus or minus 1% for everything. So that's where it sort of comes from. But I would expect more than that. But is the model working as expected? Well, COGS go down, so those are costs. You expect the share price to go up and ROIC to go up. As you can see, it does. Quite a bit. If you change a large number by 1%, it still has a big impact on ROIC. EBITDA goes up as you would expect. NOPLAT goes up. Costs are lower. That makes sense. Free cash flows go up. That makes sense. And value per share goes up as well. So the model's working as expected. All right. Other expenses, again, plus or minus 1%, everything works as expected. So the model seems to be functioning correctly. So if you decrease this cost by 1%, again, value per share, free cash flows, NOPLAT, ROIC, they all go up, as you would expect. CapEx, big expense in companies. If you decrease capital expenditure as a percentage of revenue, you should see a higher increase. You should see an increase in ROIC, margin, price per share. As you can see, not everywhere. There's a small change here. It's tiny, so it's not a big concern. That's the only one that doesn't pass the smell test, but because the number is so small, we can ignore that. It's tiny. And next, phase 2. So in KGW, remember, we have phase 2, which is after 5 years, we have a phase 2 period, sort of like a long-term growth prediction. That's down here. Yeah. These are important. Even though it's only 5-6 forecasts that you have to input, I think a lot of you found that when you play games with this number, it has a big impact on value per share. So quite a few of you had like 4% here. That's way too high. I was expecting something like 2%, 2.5%, something like that, 1.5, 1.6, a lot of you had. So if you change this to something more realistic, this is long-term growth. So this is the long-term average of both economic peaks and troughs. So the reason why 4% in the first assignment was too high there is because it assumes that the good times continue forever. The reason why you have 4% growth for a company like JB Hi-Fi in the 5 years in phase 1, and I was okay with that, is because the good times hopefully will continue for the next 5 years. But in the long term, over the next 10 years, there will be economic downturns. And this number here, think of that as a long-term fundamental average of both the peaks and the troughs. And that's why I told you to link it to something fundamental like the number of household growth predictions from the ABS, which is about 1.6, 1.5%. But if you had 2%, 2 and something, that's fine as well. Anything above 2.5 was sort of too high. Let's go back here. So that's phase 2 as well. EBITDA margin, you could have played around with the EBITDA margin in KGW. That's here. EBITDA margin, could have increased that plus or minus, 0.5%, or 1% is probably too much. 0.5%. I think this student team did plus or minus 1%, but their EBITDA was 16. And if it's 16, plus or minus 1% is fine. But if it was something like 4%, you cannot change that by plus or minus 1%. Then you'll get a huge, huge change. If you change that to 5.5, whoops, Namlock, 5.5. Yeah, that's a huge change, right? So it was 672. If you just increase it by 1%, it goes up very, very quickly, right? So you cannot change a small number by plus or minus 1%. But if it's 16%, like it's this student example, that makes sense. Phase 2, net PPE, so that's sort of long-term CapEx. That's this input number here. Yeah, you could change that. Again, you cannot do plus or minus 1% when the best guess is 3%. That's insane. Maybe 0.5% change maximum. Then phase 2, other invested capital. Again, same sort of deal, plus or minus 1%, see what happens to the key input, seems to work. Dividend payout ratio shouldn't be a big change because it happens after retained earnings. Dividends are paid from retained earnings, so not a big change to the share price as you would expect. Leases, yeah. Very important for JB Hi-Fi, for example. So if you had a lease assumption about the length of the leases, I think I told you to use 5 years. Again, that's sort of like an average of all the... JB Hi-Fi doesn't give you a weighted average life of their lease. They just give you a range. This amount of leases are less than a year. These leases are between 1 and 5. This amount of leases is longer than 5. So I told you to use 5, but what happens if you change that to a 6 or a 7 or a 4, 3, right? So in that example, it's plus or minus 2 years. As you can see, not a big change. I would expect for JB Hi-Fi to have a much bigger change on the share price because the WACC would change as well. If you WACC wouldn't change, but the WACC would change because the debt to equity ratio would change. The percentage wouldn't change. Yeah. But the overall WACC percentage would change because the debt to equity ratio, the rate wouldn't change. So another one that you can have here, and I think it's coming up here, is you change the lease rate. Right? So in the second table here, what do? So they changed the risk-free rate. This would be very important for JB Hi-Fi or any company that I'm valuing as an analyst to look at, because in that example it's 4%, currently it's 3. Oh, so currently this is 1.5. Right? The risk-free rate currently is 1.5. Or 2%, something like that. So as you can see, half of what it was. This assignment is from, I don't know, whenever, 2014. Back then, risk-free rates were 4%. Today, they're half that. That's insane, right? 4% is something more realistic. 2% is just we're in a low interest rate environment. It's very dangerous to assume, it's not dangerous, it's completely incorrect to assume that will last forever. Right? And as you can see, very sensitive. Yeah? It goes up or down just by 1%, and look at the big change in the share price and the WACC. Right? Imagine this was 2%, and it goes up by not 1%, but 2%. It would be a massive change to your valuation, at least 20% up or down. So that 20% change in your share price valuation is huge. So again, very sensitive. And then in your report about your valuation for JB Hi-Fi or whatever company, you would say that, we recognize that we're in a current low interest rate environment, which is unsustainable. If risk-free rates go to some long-term average of 4%, not 2%, this is the impact on the value per share. So your valuation consideration should be dependent on when you think the Reserve Bank is going to start increasing interest rates. Right? You have to tell that to your clients, because you tell them buy look at the value per share, just buy the stock, it's a great value. Of course it's great value when interest rates are so low. They're not going to stay low forever. And then they buy it when your valuation is dependent on risk-free rate of 2%, then central bank starts increasing interest rates and the stock prices start going down. They'll get upset at you. They'll fire you. They will not come back and pay you for more advice. Yeah? So, not good. Beta. This is again a JB Hi-Fi, very important for JB. If you did this for JB Hi-Fi, beta would be quite important to look at, because the current beta is quite low. Yeah, I think you would agree with me, historically it was a lot higher. So again, you would expect plus or minus, maybe in this student team did plus or minus 0.1, again an arbitrary number, but you could have done something that I did when I was an analyst, use the min-max beta over the last 5 years, the range, and see what happens to the value per share. You would expect quite a large change in the share price. ERP sort of doesn't move much. Historically, it is between 5 and 7, so taking 6% or plus or minus 1% is standard. Cost of debt, big one for JB Hi-Fi, huge, right? This company had a cost of debt of 6.42%. Currently, JB Hi-Fi's cost of debt is between 3.1 and 3.15, which is unrealistic. It's just so low. It is so low. And again, if you change, in this example, if you change plus or minus 1%, not a big change, but for JB Hi-Fi's case, it shouldn't be plus or minus 1%, it should be plus or minus 3%, right? And not the minus. You can actually ignore that, because there's no way that a company can get a cost of debt of 0. So for me, if I was the analyst, I would actually have plus 2% here and plus 4% here. See what happens to the share price. There's no rule that says both of them have to be plus or minus or even on both sides in a sensitivity scenario. And cost of debt will go up for all companies, including JB Hi-Fi. 3% is just unrealistic. Right? And that's why one of your adjustments in your assignment number 2 is unrealistic or artificially low interest rate, right? So in your table, and this is what I gave you a hint in the lecture, I think it was lecture 6, yeah, in this table, one of these adjustments, normalizing adjustments, remember one of those normalizing adjustments, this is assuming these adjustments are to make sure your earnings that you're using in your perpetuity are sustainable. One adjustment I would expect is the interest rate increase after tax as a result of cost of debt going up from 3% to something like 5%. You should definitely have that for 2019 and 2020, right? I'll be looking for that. I mean, there's no way cost of debt is staying at 3% for JB Hi-Fi. No way. And they cannot fix it, by the way. It's all variable debt. Australian and most companies around the world have variable debt, right? They don't have a fixed interest rate. Some companies hedge it, that's true. But remember, because ratios are in perpetuity, if there is a hedge to reduce the interest rate risk, the hedge will have a maximum length of 18 months. Again, derivatives are not in perpetuity. At some point, they have to be rolled. They expire. Longest derivative I've seen is 18 months in reality. I've never seen anything longer than, I haven't even seen 2 years. There's just too much risk for somebody to insure. Right? Insurance companies or these banks that sell these derivative contracts, they're worried about their risk as well. So if they write you an interest rate hedge for 5 years, that's a huge risk. So when they're, and I've referred to this in my, I think, last lecture, or the lecture before that, valuing banks, they care about their Tier 1, Tier 2 capital ratio, which is based on risk-weighted assets. If they were to start writing derivative contracts with 5-year maturity, their risk-weighted assets would go through the roof. And that means they have to hold back more money. And the more money they hold, the less money they make. So banks would never write long-term derivative contracts, never. As much as a company, even a company like BHP or Apple or something like that, huge companies come to a bank and say, we want to hedge interest rate risk for 5 years, they'll kindly ask them to get out of the building, right? There's just too much risk for the bank to take. That's just the way, and it's a good thing. Banks, and we saw this in the financial crisis, should be discouraged to take on risky assets and play risky games in order to chase profits, because they're so central to the economy. Without banks, there's no access to credit, and a lot of banks and individuals require credit to smooth their cash flow. Right, because if you're a company that has a 5-year project, maybe you have 3 or 4 projects, and you need to pay a big bill tomorrow, and you don't have the money, but you will have the money in the future, well, you have to go into a bank and borrow some money to pay the bill, and then you pay off the debt once the project matures with the factory that you're building or whatever it is, and you start getting cash flow from that. So you need to smooth your cash flows as a company or an individual all the time. And without a bank, there's no other institution to do that. The governments don't lend money to individuals and corporations anymore. 100 years ago, sure, yeah. Or even 50 years ago. But now it's all done by corporations, right? Companies, governments more and more step away from credit because they just do it inefficiently. So it's important for your second assignment to, I think, recognize that it's quite unrealistic to have a low interest, interest expense, which JB Hi-Fi does have, basically because the interest rates are so low. Okay. So again, if I was an analyst, this would be very important for any company that I'm valuing, because currently interest rates are just unrealistically low. And another one that's quite common is capital structure, debt to equity. So how much of the funding comes from debt and leases, for example, in JB Hi-Fi's case, how much from equity, right? That can change. Companies are in direct control in how much debt they have on their balance sheet. They can sell shares, buy back shares, they can issue debt, buy back debt. And they might, it's beneficial for companies to have debt because of the tax benefit, right? And of course, they can't have too much, otherwise they go bankrupt, because debt is something you commit to pay back. But you want to have a lot of debt, not a lot, but not too much, but enough to make it to give you a large tax benefit, right? The more debt you have, interest expense is paid before taxes, right? So the more debt you have, the larger your interest expense, the lower your tax. But the trick is not to have so much that you cannot pay back your debt and then you go bankrupt. Right, so in JB Hi-Fi's case, their debt is actually quite small, right? 470 million. It's not large. It's not large. It's not small. Somewhere in between. So it's 470 million. It's a $2.7 billion company. So that's 70 with the leases. It's nowhere close to 50-50. So as an analyst, I would sort of look at what happens if my current debt structure changes to 50-50. Or you can do something like that, up or down 10%. In this example, in JB Hi-Fi's case, if I have 25% debt and 75% equity, I again wouldn't do the minus case. There's no way the company would reduce debt. What they would do is either pick up a little bit of debt or pick up a lot of debt. So again, sort of plus 10% or plus 20% is what I would do if I was an analyst valuing JB Hi-Fi, and see what happens to the value per share, see what happens to the WACC. Yeah. So that's sensitivity. As you can see, you just change one input. That's it. And see what happens to value per share is ultimately the big outcome that you want to look at. And this way you can see what the distribution is like. So what do we have here? So it's about even, right? So it's not skewed. Plus or minus 1% gives us, sort of plus or minus share price that is basically the same. So it's quite an even distribution, not a scale to the upside or the downside. On the WACC, let's have a look. So beta up or down. The positives are a little bit higher, so it's skewed to the upside here, as you can see, but not too much, but a little bit. So if my WACC inputs were too conservative, and they ended up being better than I predicted, so not as expensive, my cost of debt is not as expensive, the share price will go up. So the skewness is towards the upside. My value per share skewness is towards the upside. Yeah? Yeah. So that was the question the gentleman was asking. So the team here sort of chose random numbers or arbitrary numbers. That's okay, maybe in university or when we're doing an assignment like this, but in practice, you probably shouldn't choose arbitrary numbers. You should look at historically what they have been, also maybe using plus or minus 1 standard deviation to come up with a number. That's better than just choosing arbitrary numbers. If you had to answer your question, if you had to choose arbitrary numbers, obviously, if you have a small number like 1.21, you wouldn't do plus or minus 1. That's why the team did plus or minus 0.1. But even for the risk-free rate, plus or minus 1 it's not small. It's a big change, but if you did it today, that should be quite reasonable because the interest rates are so low. So my advice to you is not just choose arbitrary numbers. Close your eyes and think in your head, what can this number increase to or decrease to? And if you can't come up with a number, look at the historical data. That's the way you should come up with those numbers. Not just an arbitrary plus or minus 1% or 0.5%. If you submit it like this in the assignment, I would be fine with it, but you have to be a little bit more sophisticated, and data helps with that. Historical data is quite useful here for sensitivity setup. Any other questions on sensitivity analysis? Yep.
So you say you can use this analysis to check the model?
Yep.
But previously you said
you can use two things. To check and also to see how sensitive it is. So it's two roles. Sensitivity has two sort of main roles, and the checking is sort of just to make sure your model's working correctly and everything's moving in the direction you would expect. And the other role is that actually where the analysis gets its name from, the sensitivity of your value per share or your ROIC, two key assumptions that you had to make to come up with a valuation.
Yes. Yeah. For the previous lecture, you talked about why when ROIC is less than the WACC, you increase the growth.
Yep.
The value will decrease, right?
Correct.
So it also can be a case that when we increase the growth, the value will decrease.
Yeah, it's a good question. So for those listening, previously I mentioned that increasing growth is irrelevant and it's actually destructive when WACC is bigger than ROIC. That's true, absolutely correct. But here in sensitivity, we're only changing one input, right? So if your and I think this is what you're asking, if your WACC is above ROIC and you have an increase in the growth, you should actually expect a reduction in the share price, correct? All right, hopefully the company you're valuing doesn't have that, hopefully. There are companies, of course, that you will rarely, most companies that we have what we call survivorship bias among corporations, right? The companies that exist are sort of survivors. The ones that don't exist anymore because they've gone bankrupt or they've been taken over, whatever the situation, we don't value as analysts, right? They don't exist anymore. So that's why it is more than likely, it is 99% of the time, the companies you look at as an analyst will have a ROIC above WACC, because the companies that don't have a ROIC above WACC are either bankrupt or they've been taken over for a very good price by somebody else. So that's why I didn't mention anything, but you're absolutely correct. So to answer your question, yes, if you increase the growth while the WACC is bigger than the ROIC, so you would check the ROIC here, and you would check the WACC here. So ROIC is bigger than WACC in this situation, as you can see. So when you increase the growth, the share price should go up. But you're absolutely right. If ROIC is less than WACC here, and you increase the growth, the value per share will go down. Yes. Yeah. But with sensitivity, you're just changing one figure. But yeah, if you change that figure, and yeah, the company was losing money, by increasing its growth, it's essentially investing in negative NPV projects. It's value destroying, and the valuation per share goes down. Any other questions? Good questions. Okay. Go back to the slide. So that's sensitivity. So for you guys, if those teams that didn't do sensitivity as an optional extra, don't do it for assignment number 2. I won't be looking for it, but that was one thing you can do. You could have done for maybe additional mark, depending what you did. And that's all I was looking for. Yeah, you could have even made an arbitrary change. Okay. So let's keep going here. So sensitivity has those two roles, and it's also always set up in a table like this, which you can actually include in your report when you make a report about the company that you're valuing to send to your clients. You can have a table like this. I've seen that in practice. This is what I don't like. Sensitivity and scenario sometimes is done using simulations. And then to make it sexy, the analyst says, oh, I use Monte Carlo simulation. Okay. So Monte Carlo simulation maybe sounds sexy, maybe, if you like. But all it is, and you can do it, I've seen Oracle Crystal Ball being used in practice. You can even give Excel it has a RAND function, a randomization function, so you can make it run simulations or create your own simulations using Visual Basic. You can use software instead of using historical data or plus or minus one standard deviation, whatever it is in your table for both sensitivity and scenario. You can just let the software do all the work and just have random draws from some kind of a distribution of historical values. So use simulations, a statistical approach. Right? It's stupid for two reasons. First of all, you're not thinking. The software, the problem with computers is they can't think, which is a good thing, right? Terminator, right? They start thinking, we're all dead. So computers can't think. Well, they can just they do calculations very well. That's true. And they can learn, but can't think critically like human beings can. And you need thinking when you're doing sensitivity and scenario, because you have to, as a human being, you can answer the question, is this reasonable? Yeah, software cannot answer that question. And second of all, it's lazy. It's easy to click a button. It is. It is easy to click a button, just put in historical data for the last 10 years, and just click simulate. I use Crystal Ball. It's very easy. Don't do it, right, as an analyst. First of all, you have 10 or 20 observations, annual data, for example, for a company, and simulations only work, and statistics shows, hopefully whoever talked about simulations in a statistical course warned you that when you do simulations, you need a lot of data, right? Bootstrapping, which is a term that's used, again, a sexy term that sounds, oh, you can have a small number of observations to do your simulations, doesn't solve the problem, right? It doesn't suddenly change a data set of 10 observations into 2,000 observations, right? It doesn't overcome that problem. You need a lot of data to make simulations worthwhile. So if you have a lot of data, okay, simulations make sense. But without a lot of data, and a lot of the time analysts, as I've mentioned on countless occasions, struggle with data limitation. It really is painful as an analyst. You want to do all these different things. You want to run models. You want to create your own revenue driver forecast. You want to do this, that. There's just no data. And then when you're valuing a private company, you're just completely want to kill someone because there's even less data, right, with private companies. There's no data whatsoever, and you're just like, oh, I use a similar company, their growth, it gets horrible with data limitations for private companies. So simulations are not the solution to this problem. Yeah? It facilitates a focus on the net effect of changing multiple variables simultaneously. Yeah, you can do both sensitivity and scenario, so you can change one variable or you can change multiple variables, allowing for the correlations between key inputs and outputs to be preserved, which sounds nice and it is useful. It is a scientific way of building a picture of that valuation distribution, which is what you want. What I said was the goal of sensitivity and scenario. But here's the kicker. The results will only be good as your model. A sole reliance on the data is not a good idea. Yeah. Yep. Yeah, no, exactly what I said. So it doesn't replace actual data. You don't have that critical thinking. Your simulations cannot think. Look, because it's so easy, you're just clicking a button, whether you're doing some software that the bank is asking you to use, or Oracle Crystal Ball, or whatever, you can always do it. As an analyst, you can always, in your model, have a separate tab here, just have another one of, call it simulations, call it whatever you want, simulations, and do your analysis, whatever, and run your simulations, and then never use it. You can always do that. You don't have to use all the analysis in your report. But yeah, be very careful. And I would certainly not use simulations as a justification of why an investor should buy and sell a stock. Never do that. Simulations don't have critical thinking. They just solely rely on the data. If the data is large enough, okay, it's more reliable. Most of the time as an analyst, you're frustrated with data limitations. You cannot do simulations with 20 observations. It's just beta. Same thing with beta. A few of you, for example, for revenue, did a regression to forecast revenue, few teams, with 12 or 13 observations. It doesn't matter that the R-squared is 0.8. It doesn't matter. The R-squared is irrelevant. Check the assumptions of the normal distribution, the regression, right? Do a QQ plot. Do a residual plot. You'll find that a lot of the assumptions of your regression are violated. Regression is valid when all the assumptions hold. Regression requires a normal distribution of your data. 12 observations will never be normally distributed. Normal distribution is a continuous distribution, not a discrete distribution. You need a lot of data to run it. And same thing with simulations. But you can always try it, as an analyst and just never use it. Or if somebody asks you a question in a meeting, you can say, oh, yes, I have done simulations, but this is what I got, but I wouldn't rely on it because of this. I've heard that. I was once in a briefing that somebody asked about, oh, did you test this, statistically? And the person didn't do it, so they said no. But you can always do it as an analyst and just never use it. And if somebody asks you a question about it, you can say I did it, but These are the problems. So Monte Carlo, Bootstrap, simulation this, simulation that. It sounds sexy, but be careful. Yep. Correct. Normal distribution, the reason why we can use it is because of the central limit theorem. Central limit theorem tells us that if we have enough data, the data starts approaching a normal distribution, a bell-shaped curve. It doesn't have to be strictly normal, but close enough. And regressions is fine in that situation. But with the data limitations, let's say beta, right? So to estimate beta for a company, we have essentially a regression approach. But if the company you're valuing doesn't have a lot of data in terms of returns, or it doesn't have any data whatsoever because it's a private company, so there's no returns of a stock, the stock trades privately, what would you do? The only thing that makes sense to me is you would find a closest company that is in the same industry, operates the most similarly, same business model, right, or close enough, no two companies are identical, but a close enough business model to that private company and use their data of returns. That's the only thing that I've seen used in practice that makes sense, any sense whatsoever. You can't invent the numbers. You cannot just say, close your eyes and, oh, beta's 1.3 or something like that. That's not good enough. I've seen analysts do that. Oh, there's no data, so I just guessed it. Not good enough. You have to have some kind of analysis. So with the private company data, man, it just makes me sick when I had a task. I failed it. I was given a task to value a private company, and I didn't know what to do. So I didn't do it. But with beta, the only thing that makes sense is you would find the closest comparable company and use their returns to come up with a beta estimate. But yeah, private companies are tough. They're tough. What happens in practice as well is, surprise, surprise, discounted cash flow is not used to value private companies. Ratio analysis is used. And remember ratios are all about comparable companies, average, Comco averages, this sort of stuff. And you just use a Comco average of the industry that's closest to your private company. And then you hopefully have data for at least the last year for a private company. And if not, you try to estimate it somehow. Usually when a company is trying to go public, they at least give you a couple of years of data. So you use the latest year of data and predict growth based on the industry average or something like that to come up with an NPAT figure that you need to come up with a share price. But yeah, for private companies, actually DCF is not used because there's just no data. There's nothing to forecast. So ratios are used. Yeah. It's a good question. So be careful with the simulations. Again, it sounds sexy. It's, in my opinion, never use it as a primary sort of justification for your recommendation to buy and sell something. Yeah. What makes sense is do it and only talk about it when you get a question about it, as from your boss or from a client who wants to talk about, oh, did you do some kind of a statistical distribution? Yeah, I ran simulations, this is what I found. But never use it as a main justification, never. Bad idea. Okay, so scenario. So so sensitivity is an easier version of scenario. Sensitivity, you change one input to see what happens to the ROIC or the value per share or EBITDA margin. With scenario, you change multiple things at once. Scenario, like the name implies, is a different state of the world. So what makes sense for a company like JB Hi-Fi, for example, is you have an up and down economy, scenario. So what if the economy continues to grow like it's been growing since the financial crisis, for the last 10 years? Or what happens when the economy takes a downturn that everybody, well, not everybody, but a lot of people are predicting now, right? So have an up and down case in terms of economic growth. The reason why that makes sense for JB Hi-Fi is because it's a retailer. it really moves up. It's cyclical with the economy. When the economy goes down into the toilet, people stop buying TVs. They just hold on to their older TVs. They hold on to TV for longer, right? And companies like JB Hi-Fi retailers usually suffer in an economic downturn. And in economic downturn, everybody wants a new iPhone, right? The X, God, don't get me started. $2,000 for a phone. I was playing around with it. I actually went into the Apple store on the weekend, and I felt horrible, right? Walking into the App Store, and I played with the X. It's a nice phone, but $2,000? It's insane, right? So $2,000 for a phone, I don't believe it. So guess what? People stop buying iPhones. People don't have $2,000 to spend on a phone when the economy is going down and their wages are getting reduced or they're getting fired. They hold on to their old phones for longer, right? So JB Hi-Fi sells durable goods that are longer, they have a lifespan longer than a year. Durables are first thing that people stop buying in an economic downturn. So for JB Hi-Fi, if I was to set this as an assignment, which I'm not doing, it's not an assignment. It used to be in the past, in the course, there used to be a third assignment of sensitivity and scenario. So one scenario for you guys that makes sense and is very important for JB Hi-Fi is, what if the economy continues to grow, so a positive economic outlook? What happens to the JB Hi-Fi as a company and value per share? So they keep opening, not 5 stores, but 7 stores, 8 stores. And the growth of the stores themselves are quite high. Or the economy goes down and JB Hi-Fi doesn't open any stores or even starts closing stores. Right? What happens to the value per share in that situation? Right? So in a scenario, your baseline model and resulting valuation reflect your current view of the economic outlook, the most likely outcome, what you expect. Form a scenario by asking what else could happen in terms of the company. Scenarios might be used to gauge an upside or a downside and perhaps form a probability weighted evaluation. We'll get to that. And scenarios should reflect another plausible state of the world. It's not just one input. It's actually quite a few inputs change because, let's say, the economy has changed. Right? Should reflect a plausible state of the world, not just a mechanical examination of the parameter range. That's what you did in sensitivity. In sensitivity, essentially, you did a mechanical examination of some key input changing and what happens to the valuation range. Right? Consider aspects like trade-offs, competitive responses, and so on. So you guys are too old to remember the Sliders, but when I was a kid, that was a popular show. And in the show, there was a team of 4. So it's funny. You can Google it. It wasn't that popular, but it was popular enough. It was around for a couple of years. And each week, this episode was the team of 4, these adventurers, slid into a parallel universe, into a different reality. And in the reality, for example, imagine a world with no taxes. What would happen, right? Imagine a world where, there was World War III or something like that. All these different possible scenarios. And that's sort of what you're doing as an analyst. You're assuming a change, a shock that affects revenue growth, it affects WACC, it affects your margins all at the same time. And what happens to the value per share? So let me give you an example. So this example is from an actual report. This is a scenario analysis for Telstra, largest telecommunication company. So Telstra is an interesting company because they have a monopoly. That's why they're interesting. The company is actually not very well run, in my opinion, but I wouldn't invest in it, but that's just me. But the company is fascinating because it essentially it doesn't have a monopoly anymore. It did in the past, but it's still trying to remain relevant. And one way it's trying to be relevant is in the age of the NBN. So broadband internet is what the scenario is all about. So back when, I don't know, 10 years ago, wherever, 8 years ago, Telstra had a monopoly, basically, and the government was trying to get Telstra to build faster internet. And the company was like, hold on, we don't want to do that. This is expensive, right? We are a company. Our goal is to maximize profit. We already have monopoly, so why would we spend money to have to continue having a monopoly? That makes no sense. We already have it. So the idea was, original idea for the national broadband network was for Telstra to do it, obviously. You want a private, government has shouldn't have a role to play in telecommunications. It privatized the industry. It should be companies doing it. But Telstra, because it had a monopoly, it says, why would we spend money? We already have 100 or very close to 100% of the market. So the government what it did was, this is why we had the NBN, built the NBN using taxpayer money, right? So it built on top of Telstra, and then Telstra got scared, saying, oh my God, we're going to lose our monopoly. We need to negotiate with the government. So NBN, what this analyst tried to do is have different scenarios of how the negotiations would work and end up finally. So if the negotiations were successful or negotiations failed with Telstra, what would the company, Telstra, be worth in each of those scenarios? So quite important, right? Remember, this is a very large company that had a monopoly, and this was a threat to its monopoly. So a big impact on the value per share, right? So this analyst had the following scenarios. There was a deal. So Telstra and NBN as a company, those two companies reached a deal. And they had sub-scenarios. So this one scenario, 90% likely. And they did end up having a deal. And out of those scenarios, there's 3 sub-scenarios that add up to the 90%. And then 2 additional scenarios. Right? So it was 3 scenarios, and the most likely scenario had sub-scenarios based on these inputs slightly changing. Right? So what we have here is, let's look at this scenario where NBN and Telstra negotiated some kind of a deal. 90% chance, the analysts. I assume this is just best guess, by the way. There's no data. You cannot come up with this number. It's just a best guess. So what we have here is a deal between Telstra and the National Broadband Network, where long-term fixed market share is 45% for Telstra. Long-term retail margins are 35%. The capex to sales ratio is 10%. An NBN deal has an MPV of 11 billion for Telstra. The mobile spectrum remains the monopoly of Telstra. Foxtel and high-frequency traffic is also retained by Telstra. So these are the key inputs that the analysts will be changing, basically. So based on the negotiation, these is sort of the division of the market share. Based on these divisions, the analysts got a share price of $3.34 for Telstra. Next, there's again a deal, but the market share split is a little bit different. So market share for Telstra is 50%, retail margins are higher, 40%, capex to sales, they have to spend less money, only 9%, and the NBN deal is still $11 billion worth, and they keep the mobile spectrum, Foxtel, and high-frequency traffic. The share price is $3.61 in that sub-scenario. And there is a deal, but the deal was not as attractive. Long-term share for Telstra, only 40%, margins only at 30%. They have to spend 10% of sales over the long term. The deal is still $11 billion with respect to MPV, and they keep the mobile spectrum and the Foxtel and the high frequency. And in that scenario, sub-scenario, the valuation for Telstra is $3.20. Right? So, and the analysts just did an equal weighting of those 3 deals being struck. Right? And then what we have here is 2 other scenarios. Best case scenario, NBN plan not implemented in current form. In other words, the NBN crashes. Not crashes. The NBN company is dissolved, and that would happen in that case if there was a change of government. So at the 2013 election, I think it was 2010 or 2013. It was 2010 election. 2010. I think it was 2013 actually. 2013 election, the coalition government, so Tony Abbott, was saying that if he wins government, he would dissolve the NBN, and the government would not fund the company. So the analysts predicted that 8% was actually the probability of the Liberal government winning the election, because one of their key promises was NBN was too expensive, and they would not do it. Government NBN plan not implemented. Telstra negotiates fiber to the node and metro fiber to the whatever H is rollout at the cost of capital. In other words, the government just gets Telstra to do it, and Telstra spends a little bit of money, and the the broadband still gets rolled out in metro areas. As you can see, in that situation, with those key inputs changed, Telstra, because they would preserve their monopoly, only have to spend a little bit of money on the fiber to the node capex. They would be worth $4, according to the analyst. And worst case scenario is there is no NBN deal. Telstra loses its monopoly, and there's a functional separation of the company, essentially, because if there was no NBN deal, there's a functional separation of its monopoly and no Spectrum and or Foxtel disposal. So in other words, there would be no seller for this. I don't know what the analyst was trying to do. So the functional separation is what actually happened in the UK, where BT, British Telecom, had the monopoly. And there was an issue where I don't know if it was, I think it was a private company that said, we are going to build on top of your infrastructure, and we're going to take your monopolistic position apart. You're going to have a huge erosion of your operating margin, your EBITDA margin, by 7%. You're going to lose your dominance in the wireless spectrum as well, because the other player would be able to offer those services to internet service providers, and increase capex to compete against NBN. The company Telstra would have to spend more and more money in order to keep up. So, and in that scenario, the stock price for Telstra would only be $2.58. So as you can see, each scenario has its own share price. The analysts did a probability weighted approach where they just multiplied this times this, this times that, this times this, this times this, this times this, and added it all up and got $3.42 as the final share price. So this actually is a real case. I didn't make this one. A JP Morgan analyst did this back when NBN was being considered. In practice, I don't see it often. But especially for a specific purpose like this, when it has some kind of a government decision or some kind of regulatory decision has a big impact on the share price, it makes sense, right? Because governments change regulations all the time. So you can have a scenario as an analyst where, let's say, not JB Hi-Fi, it's not really in a regulated market, but if you're valuing a company that is regulated, you can have a scenario where the regulation goes up or stays the same, right? So Donald Trump wins the election, regulations, EPA, so Environmental Protection Agency regulations, went down. In Hillary Clinton won the election, the EPA regulation in the US would stay the same or go up. All right, so a lot of companies wanted Donald Trump to win because polluters, under Obama, polluters paid, right? The environment was more protected. And if you were a polluter, a company that pollutes the environment, you would have to pay more, right? Under Trump, he rolled back, he reduced a lot of the EPA regulations to make business cheaper for big polluting companies, right? So you can have a scenario of, Trump winning or Hillary winning, and how that impacts a valuation of your company that is polluting a lot. Yeah. That also, I remember reading about it, and all the companies, hoping that Donald Trump wins, and now, he's crazy. So yeah, not good. So this is how scenario works. You don't change one input, market share. You change multiple inputs. And we sort of saw this with this example. Remember this example from last week? We had an NPV of a new project. It looked pretty good. It looked pretty good. It was NPV positive. But once we combined the project with the existing operations of a company, all we changed was the input price went down, and there was an adjustment to the amount of units this company could sell out of the new plant. So we changed two inputs, but they were key inputs, and the NPV decision was deceptive. It looked positive, so we thought, oh, we're creating shareholder wealth, but no, once we actually make it more realistic and we combine it with the existing business, we didn't even change the WACC. We could have a scenario where, WACC goes up or down, the variable costs go up or down, but in this case, two inputs changed, and in this scenario, the company should not invest in this new factory because it destroys 449, let's say, million of shareholder wealth. And then if a competitor does an expansion as well, then we have a huge loss. And if we both expand, This is what happens, right? The unit price goes down aggressively. We can sell less of our units because the market is flooded. We have to spend money. Our valuation goes down. Basically, we're bankrupt, right? So we're bankrupt. The valuation goes down very quickly. So that was an example of scenario, right? And so what I'm trying to tell you is the usefulness of a scenario usually comes for a specific purpose. Something is proposed that is uncertain whether or not it will happen. Could be a new regulation, could be a new government, could be a new competitor. And you, as an analyst, your job is to figure out if this did happen, what would be the impact on value per share on a company? That is an important question. Your clients are going to be asking that. And for JB Hi-Fi, what happens if Amazon succeeds? Right? We don't have any data on that, so we can speculate. But if we did have data, that would be a very important scenario, right? What happened in the U.S., all these retailers in the U.S. that failed because Amazon became so popular and so cheap to buy televisions and washing machines from? That would be a scenario. Amazon succeeds, or another scenario could be Harvey Norman fails, right? Harvey Norman is not doing well. I don't know if you're following the company, but Harvey Norman is not doing well as a company, right? They're struggling. And you could have a scenario where Harvey Norman fails. Right? What happens, how could that, in that state of the world, in that scenario where a key competitor fails, how would that change your valuation for JB Hi-Fi? Right? Important scenario. Right? So the usual ideas of what scenarios you look at is industry structure is a common one. A new player. It doesn't have to be a new player or a new competitor, but also could be your competitor or yourself, your company expands, and the expansion works or doesn't work. Right? Next, you could have some economics in there, game theory, like if I expand or if my competitor expand, what happens if everybody starts expanding? So this makes sense for the mining industry in Australia. Usually in the past, mining companies expanded at the same time. That wasn't good in terms of the equilibrium price went down because of a huge shock in supply. That could be a scenario. What happens if people just start expanding like crazy? Or what happens if there's a changing government, and suddenly the company you're valuing is regulated differently? The regulation goes up or down. Right? Technological change, always a common scenario. Very hard to predict. Very hard to get data for. And you can argue either way, because a technological change could actually improve sales for JB Hi-Fi. You have a new phone, new iPad, sales go up, right? Growth and other options. Well, what if a company decides to aggressively its low return assets? What if JB Hi-Fi decides to close all its New Zealand stores? Right? The New Zealand stores haven't been doing that well, if you've been reading. And what if they decided to close all the New Zealand stores? What would happen to the value per share? Or sold them. Yeah? And anything funding related, also a common scenario. What if the cost of debt, it's more of a sensitivity than a scenario, but for JB Hi-Fi, what happens if there are big changes to the cost of debt? What happens if there are big changes to the debt equity weighting in the WACC? What happens if the risk-free rate changes? Those are very important questions, right? So you could have a funding related scenario where the cost of capital jumps or access to capital dries up. There's another credit crunch like in 2008. Does this feed back into the operations? Is bankruptcy a plausible scenario? For JB Hi-Fi, not really. They don't have a lot of debt, but for other companies, that may be the case. So I showed you this example. This was from last week. It's again for this week. This is an example. What I did last week is an example of a scenario. You have some investment that you're considering. But what I tried to show you last week is you cannot look at projects in isolation. You have to look at them with respect to your existing operations. And in the scenario, you buy a new factory, you expand, but your equilibrium price has to go down, and you can't sell all your new products straight away. So there's a lag, right? That was a scenario example, right? And then what happens if you expand and your competitor expands? Ouch, right? Not good, not good. Some guidance for you guys. This is sort of the approach that I took when I was an analyst. It is an educated guess. This is the art aspect, the subjectivity of an analyst. Analysts can provide a table of raw sensitivities to key inputs. I used to do this as an analyst. I didn't put it in my report, but I put it in as I always had a separate tab in my DCF model that was titled sensitivity. And I had a table like the one I showed you, similarly to what this team did. Yeah. Then with the scenarios, you can go crazy. You can have 6,000 different scenarios. Never do that. That's a waste of time. I always examine sort of 3 or 4, sometimes even 1 or none scenarios that are the most likely. So economy going up or down, or some kind of regulatory change. Again, depends on the company that you're valuing. Yeah. JB Hi-Fi, there's not that much regulation there, so there would not be a regulation scenario for a company like JB Hi-Fi. And they don't have to be independent scenarios. They can overlap, right? Probability weighted approach sort of makes sense when you're trying to reduce everything into a single number. The weighting should be based on the likelihood, and that is very subjective. That is really a best guess, so to speak. An opportunity to demonstrate. Another thing that I liked, and analysts don't think about it this way, is a scenario analysis also allows you to show off as an analyst. It allows you to show off because you can only do sensitivity and you can only do, not sensitivity, scenario correctly if you know your company well and if you know the industry well. So because sensitivity and scenario are not, like I said in the beginning of this lecture, are not done very frequently, it is an opportunity for you as an analyst to differentiate yourself from the other analysts by doing a scenario that is possible and clearly show what happens to the value per share if that scenario takes place. Your competitors that are trying to get the same business, same number of clients that you are, will reward you if that scenario becomes relevant. If it doesn't, yeah, wasted time. That's true, yes. And time is limited, I understand. But if that scenario actually becomes relevant, you will show off that you've thought about this thing and therefore you're more knowledgeable about this company and the industry. So it's a way to differentiate yourself from your analysts that you're competing with for limited business, right? And it shows deep understanding of what drives the company value. And of course, you want to talk about the distribution, the high-low around your central valuation. Yeah. So in the past, when we valued ABC and AAX, when this was an assignment, this is sort of, I would always give students a list of possible scenarios that you can look at, and I would tell them to choose, 2 or 3. So with ABC, which is a concrete business, shift in the macro environment, obviously any economic shifts, high, lower economic activity in terms of the construction industry. That was a good one. Next, change in a competitive environment, more or less aggression from competitors. The biggest competitor to ABC was Boral. Boral was a great company, still is a great company, and a big competitor to ABC. Boral is actually the dominant player. ABC is not the dominant player in the industry. So what happens to the competitor is very important. Cost fluctuations, also what happens to the key inputs like COGS and SGA. Investing for growth, what if the company expands? It announced that it's considering expanding its concrete products that were very profitable back when we were valuing this company. I haven't looked at them in a couple of years now, so I don't know, but in the past, yeah, concrete was definitely a big source of revenue for the company. Acquisition, quite unlikely. You can identify a possible target. The company wasn't considering any acquisitions, so that's kind of like a very unlikely scenario. And loss of a major contract, again, very unlikely, but always a possible when you take, as a company, you have, you lose a contract or you lose a big customer, what happens to that value per share? If you have the data, that's always nice. Most of the time, you will not have data at the contract level, so that's kind of useless. And then for Synco, for AAX, again, economic cycle is your standard scenario that you can do. Change in competitive environment, again, sort of a standard scenario. What happens if your competition goes up or down? Cost pressures, again, a standard scenario. What happens if your costs go up or down? Maybe because if your AAX bought a lot of supplies overseas, and what if the exchange rate goes up and your products that you're buying from overseas increase in price? Yeah. Investing for growth, what if that investment turns out bad? You're just increasing capacity and your prices go down, you have a loss in revenue. Acquisition, again, it's sort of like very unlikely, but it's possible, but very unlikely situation, and you never have data on an acquisition before it happens anyway. No companies announce acquisition ahead of time. And some other inputs for AEX, again, contracts don't work out, fluctuations in the Australian dollar. They did a lot of business overseas, so always a possibility. So those were, again, unlikely. So I was sort of looking for the top 2, top 3. If the students were doing that, that was fine. The other ones were kind of unlikely. So, but no such assignment in this course anymore, so you don't have to do any scenario or sensitivity. Thank you. So next week I'll talk about making an investment decision and recommendation as an analyst. And we have some time now for questions with the second assignment, so please come up. No workshop this week.